Stop what you are doing right now. On March 5th, 2026, something happened at COMEX that the mainstream financial media has completely ignored. 511 contracts were demanded for physical delivery in a single day. Not paper settlement, not cash, physical metal. And when you look at who was doing the demanding, that is when this story gets genuinely alarming. Bank of America Securities took 255 contracts. JPMorgan Securities took 75 contracts. The same institutions that have been accused for years of suppressing silver prices are now standing at the COMEX window and demanding real bars, openly, in their own names, in a publicly filed document that anyone can pull from the CME website right now. The total number of March silver contracts standing for physical delivery has surged to 6,466. That is 32.33 million ounces of physical silver that is being packaged and walking out of COMEX storage facilities as you watch this. And here is the part that should make every silver investor pay full attention. The March delivery window is not even closed yet. The last trading day is March 27th. Investors can still demand more deliveries. The drain is not stopping. It is accelerating. I am going to walk you through exactly what this means in 4 specific sections today: the delivery report data, the JPMorgan reversal, the Bank of America play, and then the honest bear case. Because I always give you both sides. Every number I give you today is public and verifiable. Links to all sources are in the description. Let's build it from the ground up. Section 1. What the March 5th delivery report actually shows, not the headline, the mechanics. Before I give you the interpretation, I want to give you the raw data, because the raw data is more alarming than any narrative I could construct around it. The CME Group publishes a daily delivery report called the Issues and Stops Report. It shows exactly which institutions are issuing delivery notices, meaning they are obligated to deliver silver, and which institutions are stopping them, meaning they are demanding to receive silver. This document is public. It is on the CME website. It is updated every business day after market close. On March 5th, the report showed 511 contracts standing for delivery in a single session. Each contract is 5,000 ounces. That is 2.555 million ounces demanded in one day. Bank of America Securities stopped 255 contracts, 1.275 million ounces. JPMorgan Securities stopped 75 contracts, 375,000 ounces. Now add that to the cumulative March picture. On first notice day for the March contract, delivery notices were issued for 10,526 contracts, representing roughly 52.63 million ounces of silver. This delivery demand represents more than 60% of the total registered inventory, leaving a dangerously small margin for error. Substack the March delivery season opened with 52.63 million ounces demanded on day 1, and the banks kept going, day after day, contract after contract. The cumulative total has now reached 6,466 contracts, 32.33 million ounces, with 19 trading days still remaining before March 27th. Here is the context that makes that number extraordinary. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. Every single month in 2025 saw higher deliveries than the same month in 2024. FX Leaders in 2026 is running at a pace that makes 2025 look like a warm-up. January 2026 delivered 49.4 million ounces, 4.17 times January 2025's level, and 7.27 times January 2024. This occurred in a historically minor delivery month, indicating front-running behavior as market participants secured physical silver before March. FX Leaders. 7.27 times. The January delivery volume was more than 7 times what it was 2 years earlier, in a historically minor month. These are not retail stackers buying coins. These are institutions with the financial capacity to stand for delivery on 5,000-ounce contracts, doing so at a rate that has no precedent in COMEX's modern history. And now those same institutions are doing it again in March, on a major delivery month, with the vault already drained to levels not seen since before 2020. Section 2. The JPMorgan reversal. Why the largest silver short in history just became the largest silver buyer. This is the part of the story that most analysts are either missing or deliberately avoiding, because understanding what JPMorgan is actually doing requires understanding what JPMorgan was doing for the previous 15 years. And those two pictures together produce a conclusion that changes how you think about this entire market. The mechanism of suppression centered on JPMorgan's operations following their 2008 acquisition of Bear Stearns. When JPMorgan inherited Bear Stearns' massive short positions in silver, they faced two choices: close the positions at significant loss, or weaponize them for profit. They chose weaponization. For 12 years, from 2008 through 2020, JPMorgan operated a sophisticated dual strategy. Their trading desk would sell paper short contracts on COMEX whenever silver threatened to rally above $30 per ounce, crushing upward price momentum. Simultaneously, their physical metals division purchased actual silver bars at the artificially suppressed prices these paper sales created. Bar chart. JPMorgan paid $920 million to U.S. regulators in 2020 for years of spoofing and manipulation in precious metals futures. That is not an allegation. That is a documented settlement. The CFTC enforcement order is public. The DOJ resolution is public. For 12 years, JPMorgan was selling paper contracts to suppress the price and buying physical bars at the suppressed prices. That strategy worked until it didn't. The first CME Group delivery report of 2026 shows a clear strategic pivot. JPMorgan is aggressively standing for maximum physical delivery, from short and hope for lower to take it all in physical, a complete reversal. IBKR Campus. January 7th, data revealed JPMorgan issuing 99% of 8.1 million ounces in delivery notices through 1,624 contracts. What made this unusual? January open interest increased by 1,431 contracts despite these deliveries. Yahoo Finance. JPMorgan issued 99% of all delivery notices on January 7th, in a single day, and open interest went up, not down, while they were doing it. That is the signal of a market where physical demand is so acute that new long positions are being opened simultaneously with deliveries being processed. The people on the other side of those trades are not closing. They are opening. They want the metal badly enough to enter new contracts even as January deliveries are being executed. JPMorgan Chase has completely exited its long-standing short position in silver and pivoted to amassing one of the largest physical stockpiles in history. As of late 2025, the banking giant holds over 750 million ounces of physical silver, equivalent to nearly a full year's global mine production. This move marks the end of an era where JPMorgan was often accused of manipulating silver prices downward through massive paper shorts. Financial content. 750 million ounces. A full year of global mine production sitting in JPMorgan's physical vault. The institution that was the world's largest silver short is now the world's largest physical silver holder. That transition, from the dominant short to the dominant long, is the single most important structural change in the silver market in the last 2 decades. And it did not happen because JPMorgan suddenly became bullish on silver's fundamentals. It happened because the math of maintaining a short position in a market with 820 million ounces of cumulative deficit and a draining vault became untenable. JPMorgan's shift marks a pivotal moment in silver's history. The bank now holds 750 million ounces of silver, valued at over $40 billion, and controls approximately 40% of COMEX silver futures contracts. This level of institutional dominance is historically abnormal. Prior to 2025, no single entity typically held more than 10 to 15% of any major commodity futures market. The Sunday Guardian 40% of COMEX silver futures contracts. One institution, the same institution that spent 12 years suppressing the price, now holding the largest physical stockpile in the world and standing for delivery in every major contract month. When the most sophisticated metals trading operation on the planet makes this kind of reversal, you do not dismiss it as a technical trade. You ask what they know. Section 3. Bank of America's 255 contracts. What this play reveals about where smart money thinks silver goes. Now let me give you the Bank of America number in context. Because 255 contracts sounds small against JPMorgan's scale, it is not. 255 contracts, 1.275 million ounces on a single day, from one of the 3 largest financial institutions in the United States. Bank of America is not a retail silver buyer. They are not a precious metals specialist. They are a commercial bank with one of the largest balance sheets in the world. When Bank of America's securities division shows up at the COMEX delivery window and demands 1.275 million ounces of physical silver in a single session, that decision was made by analysts who had access to every piece of data I have shown you in this video, plus data that has never been made public. During the first week of January alone, COMEX warehouses experienced a 33.45 million ounce withdrawal in just 7 days, representing 26% of registered inventory vanishing in a single week. Yahoo Finance. They saw that number. They pulled the daily drain rate of 785,000 ounces. They looked at the Shanghai premium of $8 to $13 above Western spot. They looked at the China export controls that severed the arbitrage replenishment mechanism. They looked at the March open interest and the registered inventory and the coverage ratio of 0.14. And their conclusion was, take the metal now, not a paper contract, not a cash settlement, metal. The current delivery stress at COMEX is not merely a technical anomaly, it represents a fundamental shift in the global silver market. For decades, silver was treated primarily as a financial asset, with price discovery dominated by paper futures contracts. However, the implementation of strict export controls on refined silver by China on January 1, 2026, has severed traditional arbitrage routes. This has led to a persistent premium of $8 to $13 per ounce on the Shanghai Gold Exchange compared to New York prices, drawing physical metal away from Western vaults toward Asian hubs. Substack. Bank of America's 255 contracts on March 5th tell you something specific. A major U.S. commercial bank made a decision on that day that physical silver at approximately $84 to $88 per ounce was worth taking into direct possession, not worth holding as a futures contract, worth taking. That decision implies a view about where the physical price goes from here that is significantly above current levels. Banks of this scale do not absorb the logistical costs of physical delivery unless the spread between current price and expected future price justifies those costs. Section 4. The vault. The deliveries are draining, the number that puts everything in context. Let me give you the vault picture that makes the 32 million ounce delivery number alarming rather than just large. COMEX registered inventory stood at 240 million ounces in April 2020. By February 2026, it had fallen to 86.13 million ounces, a decline of 153.87 million ounces, representing a 64.1% drawdown over 6 years. FX leaders. 64.1% of the vault is gone in 6 years, and the rate of departure accelerated sharply in 2025 and 2026. Registered silver dropped from 167 million ounces in October 2025 to approximately 103 million ounces by early February 2026, a 38% plunge in just months, accelerating recently with approximately 785,000 ounces draining daily. FX leaders. Now put the delivery numbers against the vault numbers. 32.33 million ounces in active March delivery as of March 5th, against a vault that started March at 86.13 million ounces and is losing 785,000 ounces per day on top of delivery settlements. In 20 trading days between first notice day and the March 27th last trading day, the daily drain alone accounts for 15.7 million additional ounces of pressure before counting a single new delivery notice. The March 2026 futures contract alone represents 528 million ounces of exposure against only 113 million ounces of registered silver. That is more than 4 times the deliverable supply concentrated in a single contract month. Yahoo Finance 4 times. For every ounce of deliverable metal in the vault, there are 4 ounces of paper claims outstanding, and the people holding those paper claims include JPMorgan, Bank of America, and an increasingly large number of institutional participants who watched January and February's delivery data and drew the same conclusion: demand the metal before someone else takes it. While the exchange has managed to avoid a formal default thus far through aggressive margin hikes and the introduction of cash-settled alternatives, the persistent drain continues. The buffer between available inventory and delivery obligations has reached its thinnest level in exchange history. Substack. Thinnest level in exchange history. That is not my characterization. That is from a market analysis dated March 4th, 2026, 3 days ago. And the drain that was producing that characterization has continued every day since. Section 5. The India signal. What happened in Rajkot tells you the squeeze has already started. Here is the piece of this story that nobody in mainstream financial media has connected to the COMEX delivery data, and the connection, once you see it, is impossible to unsee. 44 Indian trading firms in Rajkot declared insolvency after being caught short. Yahoo Finance. 44 trading firms bankrupt in a single Indian trading hub because they were short silver and the price moved against them faster than they could cover. Rajkot is one of India's largest commodity trading centers. The firms that went bankrupt there were not speculative hedge funds making aggressive bets. They were commercial traders, companies that buy and sell silver as part of their business operations. They were short silver because they expected prices to fall or remain stable. The price did not cooperate. They could not meet their obligations. They went bankrupt. This is the exact mechanism that produces a short squeeze. Not all at once. Not in a single dramatic event, one by one, firm by firm, short position by short position. Each bankruptcy forces a liquidation that puts more upward pressure on the price. Each forced liquidation makes the next short position more expensive to maintain. The squeeze does not announce itself. It accumulates quietly in insolvency filings in commodity trading hubs. Rajkot is the first visible sign. It is not the last. Section 6. The Sprott signal. Why doubling a $2 billion physical acquisition program matters. One more data point that the 32 million ounce COMEX delivery story fits inside. On January 20th, 2026, Sprott Physical Silver Trust announced it had updated its at-the-market equity program to issue up to $2.0 billion of units, doubled from the $1 billion announced December 11th, 2025. Proceeds will fund physical silver bullion acquisition. At current silver prices, $2 billion could acquire approximately 18 million ounces of physical silver. This represents roughly 16% of current COMEX registered inventory. Yahoo Finance. Sprott doubled their physical acquisition capacity from $1 billion to $2 billion in 40 days. Why? Because at $1 billion, they were already acquiring silver at a rate that was straining their program capacity. They doubled it because demand from investors wanting physical silver backed by allocated bars in a segregated vault, not a paper contract, not an ETF with a custodian relationship, was exceeding their original capital raise. 18 million ounces, 16% of COMEX registered inventory, from one fund. That is the scale of additional physical demand being added to a market that is already facing a 32 million ounce March delivery drain, a 785,000 ounce daily vault leak, and a China export control that has severed the replenishment mechanism. The signals are not contradicting each other. JPMorgan going long, Bank of America taking delivery, Sprott doubling its acquisition program, 44 Indian firms bankrupt from silver shorts. All of them are pointing in the same direction. The question is not whether the institutions see something coming. The question is what they see and when it arrives. Section 7. The bear case. Why 32 million ounces may not be what it looks like. I always give you both sides. The bear case on the March delivery story is constructed and you need to hold it. The most important bear argument is about the nature of COMEX delivery itself. When a delivery occurs on COMEX, physical silver does not always move. A delivery is frequently a transfer of a warehouse receipt, a warrant of ownership. The silver stays in the vault unless the new owner specifically requests physical withdrawal and arranges transport. The same bar can change ownership multiple times without leaving the building, so 32 million ounces of delivery notices does not automatically mean 32 million ounces left the vault. It means ownership transferred. The metal may still be sitting in the same warehouse under a different name on the warrant. All the reports about JPMorgan closing their short position in silver are nothing but speculation. No one knows for certain if any one bank is buying or selling. The CFTC does not report specific positions, and no bank will ever come out and tell you directly what they are doing. We can speculate and use our accumulated experience to make assumptions, but we cannot make declarative statements. The burning platform. That is Sprott Money's precious metals strategist, not a silver bear, making the honest methodological point. The CME delivery reports show which institutions are stopping delivery notices. They do not show the strategic intent behind those stops. JPMorgan stopping delivery contracts could mean they want physical possession. It could also mean they are acting as custodians for clients who want possession. It could mean they are covering a prior short position that requires them to accept delivery. The report shows the action. It does not show the motive. The second bear argument, eligible conversion buffer. The total COMEX inventory, including eligible silver, not just the registered category, is approximately 366 million ounces. If eligible owners choose to convert their metal to registered status, the delivery capacity exceeds the 86 million registered figure significantly. Conversion takes 24 to 48 hours. The exchange can incentivize conversion through EFP premiums. The registered number alone understates the potential deliverable pool. The third bear argument, the margin hike tool. The COMEX has deployed repeated margin hikes currently at 60%, which compelled leveraged participants to liquidate en masse. Such forced selling can trigger violent price swings. Discovery alert. Every time delivery demand has approached a level that strains the vault in this cycle, CME has raised margins. The result every time has been a violent price crash that reduced the number of contracts standing for delivery as leveraged longs got flushed. CME used this tool 6 times already. It can use it again. And every time it does, a percentage of the delivery demand it is concerned about evaporates as margin call forced liquidations close positions that would otherwise have stood for delivery. The honest bear case summary, the 32 million ounce number is real. The JPMorgan pivot is documented. The Bank of America delivery demand is in the public record, but the eligible conversion buffer, the warrant transfer versus physical removal distinction, and CME's documented margin hike toolkit all represent real mechanisms that can manage the March delivery season without a formal crisis event. The bears are not wrong about those tools. What they cannot fully explain is why JPMorgan, with access to all of those same tools and full knowledge of the exchange's intervention capacity, chose to accumulate 750 million ounces of physical silver rather than simply relying on the paper system it helped build. Section 8. What to watch. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here on YouTube and on X where data breaks when it happens. Your watch list from now through March 27th. Every item is free and public. CME Daily Issues and Stops Report. Published every afternoon at cmegroup.com. This is the document that showed Bank of America's 255 contracts and JPMorgan's 75 contracts on March 5th. Pull it every day. Watch whether the institutional names in the stopper column, the buyers demanding delivery, continue to be major U.S. commercial banks. If Goldman Sachs, Citibank, or Morgan Stanley join JP Morgan and Bank of America in the active delivery stopper column in coming days, that is the expansion of the institutional accumulation signal. COMEX registered silver inventory, updated daily at cmegroup.com warehouse stocks. Watch whether it breaks below 70 million ounces before March 27th. That is the first visible stress threshold. Below 50 million ounces is the danger zone where the coverage ratio against outstanding delivery notices becomes mathematically acute. CME margin announcements. Every Sunday evening, if CME announces another margin hike in the week of March 16th to 20th, the final stretch before the March 27th deadline, that is the exchange using its primary suppression tool against the delivery pressure that is building. The size of the hike tells you the severity of the internal concern. CFTC Bank Participation Report, published monthly. When it catches up, it has been delayed by the government shutdown. It will show net long versus net short positions for U.S. commercial banks and silver futures. If the most recent report confirms the JP Morgan pivot from net short to net long, that removes the last major bear argument that the reversal is speculation. Silver lease rates. Currently 34.9% versus historical normal of 0.3 to 0.5%, 70 times normal. Watch whether this rises above 40% in the final week of March as the deadline forces delivery decisions from institutions that have been sitting on the fence. Section 9. The honest conclusion. Here is the full picture as of Saturday morning, March 8, 2026. March 5th COMEX delivery report. Bank of America stopped 255 contracts, 1.275 million ounces. JP Morgan stopped 75 contracts, 375,000 ounces. Total cumulative March deliveries as of March 5th, 6,466 contracts, 32.33 million ounces. JP Morgan holds over 750 million ounces of physical silver, equivalent to nearly a full year's global mine production, having completely exited its long-standing short position between June and October 2025. Financial Content COMEX registered inventory, 240 million ounces April 2020 to 86.13 million ounces February 2026. A 64.1% drawdown over 6 years. Daily drainage rate, 785,000 ounces per day. FX leaders, 44 Indian trading firms in Rajkot declared insolvency after being caught short. Sprott doubled its physical silver acquisition program to $2 billion. Yahoo Finance. The buffer between available inventory and delivery obligations has reached its thinnest level in exchange history. Substack. The institutions are not hiding. The delivery reports are public. The vault data is public. The JP Morgan reversal is documented. Bank of America's March 5th demand is in the public record. Sprott's $2 billion program is a public filing. 44 Indian short sellers are in insolvency proceedings. Every one of those data points is pointing in the same direction. And the people on the other side, the bear case, are pointing to eligible silver, warrant transfers, and CME's margin hike toolkit. Both sides are describing real mechanisms. The question that March 27th will answer is which mechanism is stronger, the physical demand that is pulling registered silver out of the vault, or the exchange's institutional toolkit for managing that demand without a visible crisis event. I do not know the answer to that question. Nobody outside CME's Global Command Center does. What I know is that when the world's largest former silver short and one of America's 3 largest commercial banks are both standing at the COMEX delivery window demanding physical bars in the same week, the people who built the paper system are no longer trusting the paper system. That is not a prediction. That is what the delivery report says. The data will tell you what happens next. Pull the CME issues and stops report every day between now and March 27th. Watch which names appear in the stopper column. Watch whether the registered inventory falls below 70 million ounces. Watch whether another margin hike arrives on a Sunday night. Let the data build the picture. Invest with logic, not hype. Protect your capital. 32 million ounces is leaving. The institutions taking it know something. Your job is to figure out what before March 27th. Follow the metal in the comments if you are pulling the CME delivery report daily between now and the last trading day. And drop JPMorgan Watch if you want me to cover the next delivery report the moment it drops this week.